that wealth strategy dashboard is the one thing that can help kind of keep you disciplined and moving forward, but also celebrating your successes and being able to adapt and adjust to the market.
Welcome to the Wealth Strategy Secrets of the Ultra Wealthy podcast, where we help entrepreneurs like you exponentially build wealth through passive income to live a life of freedom and prosperity. Are you tired of paying too much in taxes, gambling your future on the stock market, and want to learn about hidden strategies for making your money work for you? And now your host, Dave Wolcott, serial entrepreneur and author of the best-selling book, The Holistic Wealth Strategy.
Hey guys, welcome to another episode of Wealth Strategy Secrets. Today we're joined by the one and only Jason Nees. Jason started his career as a financial advisor working at investment firms including Morgan Stanley and Merrill Lynch. For over a decade, he helped investors plan and invest for their financial future. While debating his future in financial services, he was recruited to help raise capital and manage the business development team for a consumer finance company. After several years and raising over $300 million in capital, he decided to leave and start his own business. After running that business for 5 years and selling it, he was left with a windfall, but also some large tax liabilities. From that point forward, Jason began investing in and focusing on alternative assets that can grow wealth with tax efficiency, consistent cash flows, and additional upside potential. He joined Pantheon Investments to help investors better understand the benefits of these alternative asset classes. Jason, welcome to the show.
Well, thank you so much. I'm happy to be here, Dave. That was quite the intro. I appreciate it.
Yeah, you bet. This is really cool that we're going to give folks an opportunity to really learn a little bit more about you and really the unique perspective I think that you bring, into this world of wealth building and everything, and which is why you've made such a great fit, on our team. So, can you unpack as we kind of start this off, why don't you tell the listeners, people who haven't met you yet, tell us a little bit more about, your story, your background, how it all kind of started for you.
Yeah, that's kind of a longer journey. That's going to be an interesting one. So I actually first started my journey in the Army. I spent some time in Hawaii for 4 years. And the main reason was I really wanted someone to help kind of pay for college. I've always been interested in finance since I was a younger person. Went to school for finance. And I actually started, and interestingly enough, my very first position out of college was with an investment bank. And so I was in investment banking for a year in New York City and ended up transitioning to wealth management. And a quick little tidbit about me is I have a son who has autism, and the city wasn't going to be the best environment for him. And so transitioned back to the Midwest and transitioned into wealth management. So I started working as a financial advisor at Merrill Lynch, working with a number of clients on financial planning, kind of moving them towards their goals, whether that be, retirement, asset management, et cetera. And did that for about a decade and really kind of very happily left the industry. It was just after about 10 years of doing it, I was quite disenfranchised with the kind of industrial complex of that style of investing, and was very happy to be recruited away to a consumer finance company, which is where I learned quite a lot about investing, as well as, investing in credit style vehicles. I'd say one little tidbit about, kind of the financial services, Dave, is, the reason that I was so happy to leave that environment was seeing a lot of my clients and kind of following the traditional asset allocation principles and literally just kind of walking through the steps of okay, where did we go on this journey? And, over 10 years, when you talk about having traditional kind of 7-8% returns, I watched it in real time, and there weren't any major blowups, there weren't any major explosions, but in the market, but the progress, these people had to continuously feed their accounts to kind of offset and battle the fees, taxes, et cetera, that were just generated by turning over portfolios over and over again. And so a long way to say, that is kind of the crux of what led me to the alternative space, and was kind of my personal experience of being kind of disenfranchised with just buying stocks and bonds and turning them over and over again. There was a client of mine who showed me in real estate that he was investing, and I actually wanted to participate in his real estate myself, but Merrill Lynch being Merrill Lynch, it wasn't a deal that was sponsored by them, and I couldn't get compensated for them, and the firm subsequently couldn't get compensated, and so it was a hard pass, and I had to pass on that opportunity. But coming full circle to running a business, selling a business, and kind of having a windfall moment was the opportunity for me to actually go back and seek that. So, kind of reconnected with that former investor and started on the journey of alternative investing.
Yeah, no, that's awesome. It's such a unique perspective, and I know there are, some folks out there that have that, right? They've kind of they've transitioned from that, traditional financial planning model into the alternative and real estate side, and certainly, one of the observations that I had made across my journey as well, and as we unpack the wealth strategy secrets of the ultra wealthy, I mean, that's completely one, right? Which is, making sure that you're investing across different buckets, right? As Michael Sonnenfeld was talking about, investing in private equity and alternatives, investing in real estate, right? Having a good, cash position and things such as life insurance to really be able to have that kind of all-weather portfolio, right? That gets you through different things. So you don't have everything kind of tied up in, what I think are traditionally more investment or riskier type investments, stocks, bonds, mutual funds, and of course loaded with, taxes, fees, and inflation. But what do you think, Jason, I mean, given your experience, did you have any aha moments or, in that journey of kind of transitioning, were there particular lessons that you learned?
Yeah, I would say there were several probably smaller lessons. I would say one, being an entrepreneur and selling a business and not adequately planning for kind of the taxes of that was a driver. And when I started to look and say, okay, here's our overall landscape of things that we can choose from. You could choose stocks or bonds or dividends or single family homes or rentals. I started with a couple single family homes and initially thought I was going to kind of build that out. I kind of learned a hard lesson in that I didn't really want to do kind of property management and didn't really want to pay 10% for a property manager. And so I thought, kind of next, let's scale up. And so we scaled up to an apartment complex and should have carried over and learned the same lesson that just for me personally, having to be involved with property management wasn't kind of a freedom of time moment for me. And so ended up kind of liquidating those and really started to focus more on how can I participate in other kind of syndications or investments where there is passive income, there is forced appreciation, there are tax benefits, kind of the holy trinity of things that we tend to look for. And I think for me, just learning both as a personality fit, but as well as actual expected returns, they were just far higher by participating in leveraging others' expertise rather than relying solely on myself. And I think that was a big lesson learned for me.
Yeah, makes sense. So has that created for you a particular investment thesis that you have or your own wealth strategy that's been guiding you?
Yeah, I mean, I rarely, if ever, participate in the stock market. I own a couple stocks that I'll probably have for my kids someday. But for the most part, I really only do private investments. And when I say private investments, I mean whether that's private credit, commercial real estate, industrial warehouse, or triple net real estate, which I personally do. And so from that standpoint, it's about trying to create that wealth kind of flywheel where I can rely on others' expertise. I can put capital to work in opportunities, but I'm also entrusting partners to help me realize that. And so as my thesis, essentially, I really do look primarily towards syndications and or commercial real estate individually to grow, multiply, and build that wealth, but also create some freedom of time so that my investment, I'm not beholden to the investment. And I can just continuously put capital to work and create that kind of flywheel effect. When one rolls off, I find another good opportunity to roll into.
Has that created a particular asset allocation model that you're preferential to?
Yeah, so I would say not necessarily from the standpoint of maintaining diversification. But I tend to have a little bit more of an open approach, and since I have kind of a wide array of knowledge about different financial products, I don't have a specific model that I try to fit into. For me, it's about finding asymmetric kind of risk return profile, and if that means that I allocate something to a field that I don't have as much expertise in, and I can leverage somebody else's expertise, doing so, yes. But for me, it's more about not allocating more than call it 7 to 10% of my capital into any specific idea, but I'm willing to go kind of wherever that capital is going to be best treated.
Yeah. So why don't we talk then a little? You mentioned the credit fund, that had recently come out, and you've also had some background and exposure in this sector. We've now got almost 2 months of performance with the current fund, and I've found it to be such an excellent diversity play. Really, right, in terms of diversifying your portfolio, creating cash flow that everyone is looking for, and then also having the flexibility to have growth, or cash flow in that. But, I think a lot of people aren't really familiar with the asset class of private credit. So can you kind of unpack that a little bit for us?
Yes, I mean, to that point, Dave, I mean, I think my first experience with kind of credit was at the subprime consumer company that I worked for a number of years, where I was responsible for both bringing in capital, but also responsible for overseeing the delinquencies. But I got my real first taste for how the underwriting was done and how to manage a collections team and things of that nature. And it's kind of what drew me to merchant cash advance as a business. Merchant cash advances is a industry that didn't even exist 20 years ago, but is doing about 20 to 30 billion dollars in this year. And there's a very natural, progressive reason for that. Is that it's traditionally hard for banks to move quickly, or as quickly as a small business actually needs. So, starting my own business, I experienced this myself. If you think about a business that needs capital in a short period of time, there are many reasons why getting a merchant cash advance, while it costs a bit more, is just a much better decision for the business than it is to wait 3 or 4 months to go through underwriting. And so we participate in merchant cash advances and do so in a very diversified way, in that we're participating on a platform that a number of other hedge funds or other institutions will participate in. Our credit fund will traditionally participate in 5 to 10% of any specific deal to provide that diversification, but also to provide that kind of asymmetric upside, where it's an investment that has a high rate of return, but is spread out and diversified across a number of industries.
Yeah, no, I think the point that you make, right, about the industry, right? I mean, this was really a nascent industry, right? That's just been growing. The combined annual growth rate is well over 15% and continues to accelerate. All of the issues with the banking crisis that happened earlier in the year, just further propel, right, the business case for merchant cash advances. So, we expect as a sector that this is going to continue to develop. And, as you rightly pointed out, I mean, being a business owner, you realize like how important capital is, right? It's the lifeblood to expanding a business. And that's the type of capital that's being lent, right? It's businesses that are growing. Right. So they're doing well. They have a proven model. They're looking for additional capital to be able to scale their business. And if you go to a traditional bank, it might take 3 to 6 months to actually get the funding, if you can even get the funding. And in the meantime, you turn around, cash advance. They've got the capital in a week. They start paying that back to investors pretty quickly. So I think it's a really nice play, for a couple of reasons. One, really nice diversification across, asset classes, right? That you're in something else. And then, the risk mitigation in this is interesting as well. So tell us a little bit about the default rate and how that kind of works. What has it historically been? And how does that work?
Yeah, so kind of historically, if you kind of look over the last 5 years, the default rate will run anywhere between 5 and 6%. Sometimes a little cooler, sometimes a little hotter, but that's been the general average. you have to think about the fact that a business is repaying a loan kind of on a sometimes daily, weekly, or biweekly basis. So you have a lot of factors playing in that you can see play out. And you can see that if a business hits a road bump or a speed bump or something happens, we have the ability to adjust and say, okay, business, you have, a week or two to kind of, get your affairs if some one-time event happened, and then they get right back on track. And so, to that point, from a delinquency standpoint, as soon as a payment may be have an NSF, we have a third-party team that immediately reaches out to the merchant, tries to identify what the issue is and figure out how to solve it. In some cases, it's something silly like they blocked a checking account from a large check coming in or something of that nature that can be easily, quickly mitigated and got back on track. We've experienced a couple of those. But it's the nature of lending is that there will be delinquencies, they will be cured, and things will default. But there is a reason why we're mitigating risk and spreading that over a number of merchant cash advances. And we deploy new money on a daily and weekly basis to continuously doing that. And participate in the asset class. But, obviously risk mitigation is very important to us, and providing that and doing that in a reasonable fashion, making sure that they go through all of our underwriting criteria before we actually participate. All things are there to, kind of protect the portfolio, the health of the portfolio, as well as protect the returns for our investors.
Yeah, so that's a great segue. Why don't we transition into just, overall how you're really analyzing investments? How are you mitigating risk? What are the things you're looking for when you're trying to identify opportunities?
I will tell you, this is one of the more interesting markets that I've seen in a number of years. And I've been, watching the market in all facets for a number of years. And it's a unique time in investing for us, in that we've had interest rates rise, kind of faster and higher than they ever have before. We've gone through a period where, kind of 13 years of near zero interest rates has suddenly just kind of been over. And so, Dave, we get a number of deals that we look at on a weekly basis. And, it is a tough environment in that when I even talk with other allocators, I hear the same phrase over and over again: I just can't make this pencil. And so, part of that is an adjustment in the markets. I think that cap rates will naturally start to go up as we go through this, and there will be pockets of stress in the market. But doing that work of kind of due diligence, so Pantheon has a 50-point due diligence kind of framework that we go through to analyze these deals and make sure we're considering all the factors before we put capital to work. And I will tell you that of the ones that we've reviewed, most of them at this specific moment haven't kind of passed. But, I have the fundamental belief that when you find yourself in a market like this, if you just continue to look for opportunities, there are opportunities out there. We just have to keep searching for them and keep doing the work behind it. There are good deals, and there are good places to place capital.
Yeah, what would you say would be like, say, your top three, if it's a 50-point, kind of cycle around due diligence points that you're looking at? What would you say are some of the top three things that you look at?
Yeah, so I think it's always very important, especially if you're participating with another general partner, is who is the actual sponsor and what is their track record. Kind of always the big red flag for me. If you've only got maybe one full cycle under your belt, you're probably not going to be where I'm going to be looking to allocate capital. So track record is certainly important, but character is another one. I mean, obviously, if you're entrusting somebody as an expert, having reliable references and investors who have successfully invested and participated with them is a big deal. And moving past that would go down to kind of the property as well as the debt structure. I would say debt structure today is more important than it's been in the past. Again, with zero rates moving to 5.5, it makes for a different market. And so, trying not to identify properties that aren't in variable rates with shorter timeframes, because as we go through this period of adjustment of higher rates and cap rates come down and prices come down, it's just a reset of expectations. And so what we're really looking for is a margin of error for the unknowns that are going to happen in the next 3, 4, or 5 years. I would look at it from the standpoint of kind of character analysis and track record, property specific, and what's the business case? Does it align with realistic expectations? And overall debt structure. Does this financially work and make sense?
Yeah, for sure. And then in terms of, other asset classes, do you see other opportunities, right? So, given interest rates, right, real estate, multifamily has definitely been impacted, right, based upon the interest rates. But any other sectors that, have less exposure to interest rates or that, you've been kind of tracking that look to be good asymmetric opportunities?
Yeah, I still keep an eye out for multifamily because as we progress through this, I expect to see some distressed assets that we may have an opportunity to pick up some bargains. But the same would apply in self-storage. There's going to be some, as we look through moving these interest rates from 0 to 5, for anybody who structured a deal that was over leveraged, we may find some diamonds in a rough there. But I do think, kind of self-storage as an asset class, car washes are a unique opportunity as well. I have a number of investors who kind of talk about different ATM funds. So as I start to look through them, some of them have all of the characteristics of the things that we typically look for in that upside value, that passive income, as well as the tax benefits. And so I do see opportunities out there. It comes back to the overall structure and continuing to look at new and different asset classes because real estate is going through kind of a transition, but also because it's important from a diversification standpoint to help our investors not be too over leveraged in any sector.
What would you say is your current take on the market? There's just been so much kind of going on this year. It's almost mind-boggling, right? When you really think about all of the different, from geopolitical events that are happening across the world, bipolarization, rise in interest rates. I mean, just so many different things happening at the same time. How do you make sense of it all, right? And what would you say is your outlook for the remainder of the year going into 2024?
Yeah, so when it comes to the stock market, it is one of the most confounding things to me at this specific moment. And really as the year has progressed, I mean, if you looked at the start of the year, everybody was kind of universally bearish across the board, and the market just first half up 18%. A lot's been kind of speculated and talked about on kind of the big eight stocks essentially driving the entire market higher. So the S&P would be flat to down if it weren't for those 8 specific stocks. It's been talked about quite a lot. But one of the things that does confound me is that theoretically, as Fed rates move up, the risk premium generally for investing goes up. So your risk-free rate, which was 0, is now 5 and higher. But investors continue to plow money into the stock markets at very high elevations. You could take NVIDIA, for example, at the price to earnings that you pay for that, it would take 40 years at their current rate to actually get that money back. Again, the expectation is that the E part of that multiple of earnings goes up through AI and demand. But I see this in a lot of places in the market where the valuations just don't make sense. So, I don't have a favorable outlook for the latter half of the year. I don't see the risk reward there. It seems more risk than potential reward on the upside. Historically, when we get to the end of kind of a zero market cycle, you'll get a reversion to the mean. I may be wrong on the timeline. I may even be wrong on the direction, but that's my personal outlook is that I think there are better, more efficient places to place your capital with less risk.
Yeah, good observations. One of the things, Jason, for me along my journey was, you hear some good podcasts or some people talk about things, you kind of get some ideas, you get a little excited to take place in an opportunity or something. And there comes this, point where you just kind of have to, you can't be in this mode of paralysis by analysis, right? You just have to kind of, move forward. But one of those things that really helped me do that was just objectively looking at the numbers, right? And really trying to break down a particular investment and then compare that versus another investment and then make assumptions based on your comfort level, based on your risk tolerance. and what you think kind of works for you. And then when you do that and you can kind of compare apples to apples, for instance, when I exited my 401k, I thought it was really interesting to, compare that against, if I progressively invested in multifamily assets, for a period of time, I would reduce my taxes, I would increase my return, and then that return just becomes kind of exponential, right, with a compounding kind of over time. I've been so excited to bring to investors in our mastermind and virtual family office community the wealth strategy dashboard. Right, which is essentially a software tool that helps investors make those types of decisions. So, for instance, if you're looking to achieve, your income exceeding your expenses and have that financial independence number, let's say in 10 years, well, okay, what's the quickest way to get there? And then if I reallocate my portfolio from, say, an equities position to moving into maybe a combination of single family rentals and some syndications, how can I get there quicker?
Yeah.
Right. If I can reduce my taxes maybe by 10% by doing something particular, I can get there. But when you get that objectivity, in the software and the calculator, and you can kind of see that, then all of this stuff really starts to kind of materialize. So can you share with us, some of your initial thoughts, especially, as a prior financial planner and working through something like this, to look at, not only equities holdings, but other, asset classes in your portfolio?
Yeah. Great question. And, I think it's a very, very powerful tool that we created. It's one of the, kind of the first times I've ever come across a tool that says you can actually manage a whole number of investments, but put it into a holistic picture and get an idea of where you are today and make a plan for where you want to go. Again, being from the financial advisory side, on that side of the business, you only get one half of the equation, and that's in stocks and bonds and maybe some mutual funds or ETFs, and that's it. But if you wanted your financial advisor to evaluate your business or your rental properties, they don't generally, those are line items on a financial plan, and it's not even considered as far as, does the value go up? Are rents going up? What does your passive income look like? It's kind of left out of the equation. It's just a frozen asset in time. Where the wealth strategy dashboard provides a lot of value is that we realize that this is the real world where these valuations change. The passive income may increase from 1 month to the next higher than your projections. Your multiple on exit may move higher than what you were anticipating. And so it's a real world tool that allows you to see the adjustments, but apply rational logic to how am I moving from here and how do I actually get here? If my goal is to 10x my wealth, I need a plan to start moving accordingly, but I need to see where I am in a full picture first. So I think that's the power of the dashboard. And I think, I know that it's been useful. I've used it with a number of our clients already and have already started developing plans to kind of 10x their wealth and move them down that path. But it's a concrete tool that allow you to visibly see it, but also track the performance as we go through.
Yeah. And I think so key in that too is just really understanding people's goals, right? Because you've got different goals. Everyone has different goals, right? But how can you track towards that and make incremental progress? Because if you want to get to some real exponential growth and you have really big goals, it's not going to happen overnight. Right? When we want to really put a system in place and kind of have a methodology to how you're investing. And in fact, that's why, the majority of people lose money over time, right? Because of the emotion in it. And they're changing course, midstream because of, something's happening in the market or in their life, versus if you have this strategy that's outlined for the next 10, 20 years, you just keep building on that, right?
Absolutely. Yeah. Investing is a lot like a marathon. You don't just run a couple 10Ks and expect to run a marathon. You've got to do that repetition and put in the work. And that wealth strategy dashboard is the one thing that can help kind of keep you disciplined and moving forward, but also celebrating your successes and being able to adapt and adjust to the market.
Yeah, 100%. So, Jason, on a personal development perspective, what would you say has been, the one, practice that you've done that's actually yielded the biggest results for you?
This is probably not a popular answer, but I would say treating due diligence like a religion. It's the one thing that's helped me to avoid pitfalls for things that I was personally attached to, that I really wanted to make something work, and I didn't really do it. The times when I've done that in my life is usually when I've lost the most money. I was emotionally attached to something. So I would say due diligence is one, but also kind of having a fast filter to be able to know that these are my experiences and this is what I do understand, but I can look at something and make a snap judgment and probably have a higher than average probability of being successful. But again, it's only by doing it over time. I would say those are probably my two big ones, Dave.
Yeah, great. And tell us, we have so many parents in the audience, right? And, our children are our pride and joy. And, you get out of them what you put into them, right?
Yeah.
And, family is really everything. And I know I had challenges, right, having triplets, as everyone knows. But I mean, tell the audience, having a child with autism, must create some, extraordinary challenges, for you and your wife and the family and how you guys operate. So how have you been able to, manage through that? And, do you have any kind of strategies that you can help other listeners with?
Yeah, I mean, from a strategy standpoint, for any parent with a child with special needs, planning is utmost importance. There are special rules for, Social Security and how you navigate that for somebody with a disability. Financial planning, everything needs to be in trust. You need a team of special needs advisors to kind of help with that. And I think, I would say that very early on, it was probably something poor that I used to say. But one of the things I used to say to my wife is, some days when it's really tough, I'm kind of thankful that I don't have a choice in the matter, because it forces you to kind of work through it and go through it rather than to maybe run off and hide. But it's been interesting. I've learned far more from him than he's probably learned from me. Patience, I've learned. So a lot of things.
Yeah, that's awesome. Well, kudos to you, man. It takes a really courageous person to be able to do that. And, your wife must be a saint as well, and keep the family strong. That's really awesome. So appreciate that. And then I guess, final question for the audience is if you could share just one piece of advice, to listeners about how they could accelerate their own wealth journeys, what would it be?
Action. Take action. Move forward every day and be better than you were the day before.
Yeah. Awesome. Fourth phase, right? In the holistic wealth strategy, take massive action, right? To
Absolutely.
get there. Yeah. Awesome. Well, Jason, really appreciate you coming on the show today, having the opportunity, for listeners to get to know you and everything. And if people, want to inquire more, kind of connect with you, what's the best place they can reach out to you?
Yeah, so you can send me an email, go to pantheoninvest.com, and you can find me there. You can reach me by email at jason@pantheoninvest.com. That would be the easiest way.
Awesome. All right, guys. Thanks again for tuning in today. Really appreciate you spending your time with us. Please do us a favor. If you're getting value out of the show, please go in, give us a rating review. It really helps us amp up the level of guests. And we've got an awesome lineup for the rest of the year, but we continue to expand on that. So really appreciate your support there. And again, we're always here if you want to work through some wealth strategy on your own to take your game to the next level. Until next time, thanks again.